Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. There is a category of mutual funds that has been getting a lot of attention, and that is balanced advantage funds. It's not a new category, of course. It's existed for some time, but particularly because of the change in the taxation of fixed income mutual fund instruments and the way that balanced advantage funds are now taxed because they have a certain allocation towards equity, it's become a lot more attractive for those that are looking to have a certain amount of their portfolio in fixed income. They choose to do it through the balanced advantage fund. But that's only one reason why people do go towards the balanced advantage fund. The other, of course, is that it mitigates risk to a certain extent by dynamically shifting between equity and debt. It is also called the dynamic asset allocation fund. We're going to talk about the different approaches that fund managers have in the mutual fund space to this particular category, because they're not all the same, and what you should look for when you're investing in these and how these funds have done. We'll also talk about a proposal that came through from the Securities and Exchange Board of India that I think is important to debate. It's a consultation paper that talks about maybe the possibility of mutual fund houses being allowed to launch a second scheme in the same subcategory. So for example, if they have a small cap fund, which is very large, they have the option to launch a second scheme, which could be called a tier 2 scheme. And well, the question for you is, does that make sense? And are there more problems that can occur because of that? We'll talk about that as well. Joining me today is Mrin Agarwal, who is a financial educator and founder of FinSafe India, and Varun Fatehpuria, who is the founder and chief executive officer of Daulat Wealth Management. Thank you so much to the both of you for taking the time. First, let's talk about balanced advantage funds. Varun, I'll come to you first. What are they, and what is the primary objective that someone should have when they're looking to invest in these?
So Alex, firstly, thank you for having me back on the show. As the name suggests, the more formal name of dynamic asset allocation, the fund managers and the fund houses are able to dynamically manage the allocation between two different asset classes, mostly equity and debt, depending on what the market valuations are and the relative attractiveness of each of those asset classes are at any given point in time. So it falls under the hybrid category of funds, the balanced advantage funds. And most of the fund houses would run this as a debt plus equity minus scheme, if I were to so categorize that, aiming to provide investors with obviously returns higher than what traditional fixed income instruments could provide, and returns may be slightly lower than a pure equity fund, but at the same time, managing to control the downside which comes with participating in a pure equity fund or the perceived lower nominal return in a fixed income instrument. So that is where most of the balanced advantage funds actually typically play in the market. Obviously, the strategy itself depends on what the fund manager intends to provide to the investors through that scheme.
Okay, Mrin, do you want to add to that? Also, what is the ideal time frame that someone should have in mind when they're investing in the balanced advantage fund? And of course, sometimes, or rather a lot of times, you invest with a certain goal in mind. What are the kind of goals that you would look to achieve through investing in the balanced advantage fund?
So thanks, Alex, for having me on the show. And I think the Balanced Advantage Fund is like an all seasons fund in the sense that anybody can have it in their portfolio. Of course, given the fact that there is equity exposure, and in most cases, the equity exposure is going to be more than 50%. So given the fact that there is a good amount of equity exposure, I would say that the minimum period of investment would be at least 4 to 5 years. So I would say ideal period of investment between 5 to 7 years. But that being said, I think, Balanced Advantage Fund is such a category which is like a no-brainer fund, right? So if you have an investor who's not sure about how much to put in equity, how much to put in debt, and they don't know when to rebalance, so even if you're clear about your asset allocation, Alex, what happens most of the times is that one is never sure when to do the rebalancing and on what basis to do the rebalancing as well. So I would say that this is a great fund for all of those investors who want one fund that's taking care of all of their asset allocation and rebalancing. And of course, it could be used for any goal that could be there in the 5 to 7 year time frame.
Okay, all right. So let's talk about how these schemes are managed differently, because it's pretty much a blank canvas to a fund manager about how to manage it within certain overarching limits that they need to maintain. But Varun, they're handled very differently. Would you agree? And can you give me a few examples?
Yes, Alex. I mean, as you correctly pointed out, how fund manager and a particular fund manager obviously positions this fund in the market depending on where they are seeing the opportunities. They actually, true to its name, manage it dynamically, right? The net percentage allocation to equity at any given point in time. So obviously, internally, they could have various parameters that they look at in deciding the attractiveness of each of the asset allocation, right? So let's say they could look at something like a price to book or a price to earnings or earnings yield, uh, vis-a-vis what the levels are for the benchmark indices, and decide what the percentage that they need to allocate to equity at that point in time. Having said that, obviously, given the number of schemes that there are in the market and the AMCs, they run it very differently. So let's say something like a Parag Parik, right? Even though they have that dynamic asset allocation, over the last year and a half, the average net percentage equity allocation has only been anywhere between 12 to 15%, right? But let's say if I look at the other end of the spectrum, someone like a Quant or a Samco, right? They have gone as high as 80 to 90%. So obviously, investors need to understand what they are buying into. If they are buying into a fund where they need to balance equity and debt, then ideally they need to look at funds having allocation anywhere between 50 to 60%. And that is the rough average allocation, which most of the fund houses tend to also maintain to provide that favorable equity taxation.
Okay. Mrin, you've actually listed out a few strategies that these balanced advantage funds use with examples. So can you take us through that?
Sure. So just adding on to what Varun said, yes, he talked about the various parameters like PE or price to book value or earnings, for example. So the most common one would be the counter cyclical strategy where you're basically buying low and selling high, and that's the ideal thing that you need to be doing. The second one would be pro cyclical, which means that you're basically following the trend. So if you believe that equity markets are going to go up further, you're actually increasing your allocation to equities. And of course, this is like a very aggressive strategy to have. Then you have funds which do a combination, so they do multi-factor strategies. For example, they take into account the sentiment, they take into account valuations, they take into account earnings, and you also have funds that look at macroeconomic factors as well. So I would broadly say that it is either counter cyclical or it is pro cyclical or it is based on multi factors, which takes into account valuations and macroeconomics. And each fund creates its own model. And as Varun rightly said, that while BAF is a very easy product to understand, but within that category, the fund really needs to be chosen based on which end of the spectrum do you want to be in. Do you want to be aggressive, or do you want to be into something that's going to be more moderate and follow the book, which is buy low and sell high?
Uh, I'm also wondering, Varun, how much attention as an investor you should pay to the debt composition of a balanced advantage fund. Because I remember, and this is not recent, this is actually quite a long time back, maybe even before ILFS, where we were talking about the books of some of these balanced advantage fund that had a certain amount of credit risk that they were taking. They were going a little lower in the credit risk parameters that were allowed to them. Of course, it's allowed to them. They could buy corporate bonds, but they were not necessarily all buying AAA rated corporate bonds. And a lot of people don't necessarily understand debt to the extent that they do understand equity. So how much attention, Varun, should you pay to the composition of the debt?
So obviously it is important to pay attention, but let's understand how the fund houses and the fund managers are able to provide a debt-like return. So obviously you play with the traditional fixed income instruments in buying into GSECs and buying into AAA rated bonds, AA rated bonds. And that is where we are seeing most of the universe for these fund management companies actually tend to stop. Going beyond below AA or A rated securities, I think due to the thinly traded nature of these securities itself and the perceived risk which comes into the picture, I think most of the fund managers after the ILFS and DHFL crisis has almost stopped taking any sort of a credit risk. where they are actually playing fixed income is also through the cash futures arbitrage, right? In providing a more favorable fixed income like experience without taking a direct debt exposure. So yes, there continues to be a significantly high debt component, but that is played equally between fixed income and what they would classify as hedged equity, which could be a debt-like exposure as well.
Okay, so it's interesting that you point this out. So they play duration, and by duration, effectively, you're talking about viewers. This is how you would look to gain capital when you're investing in a bond, right? Because in a scenario like we're experiencing right now, the Reserve Bank of India has cut interest rates over a period of time, and it could well cut interest rates further given the last inflation print, which is at a multi-year low. So when the yields, that is the interest rates that are offered on bonds, when the yields to maturity are falling over a period of time, your price of the bonds are rising. There is an inverse relationship between the two. And so if you're holding a bond, when the yields are falling, you're gaining. And that's how you make capital gains. But you play that by buying, say, a 4-year or a 5-year or a 10-year bond. The further you go down the duration of bonds, the more the potential for capital gains and also capital losses are when the yields change. So, Varun, the question to you then is, how many of these balanced advantage funds, in your experience, are playing that duration, and how many are actually doing arbitrage, as you've suggested, which actually has become a pretty popular category in and of itself?
So I would say the number of schemes which are actively managing duration and taking the longer end of the tail curve risk is significantly low, right? They have a separate sort of category in debt funds itself through medium duration bonds and medium to long duration and long duration, where they know the kind of investors that are coming into these funds have a certain amount of expectation that they have. So typically we are seeing they play anywhere in the 3 to 5 year bucket where they are finding the yields to be a lot more attractive compared to the longer end of the curve. And obviously, over the last year, I would say they have benefited significantly where these duration strategies have delivered anywhere between 9 to 10% at the other end of the spectrum. So yes, they do play duration, but my suggestion and understanding is only limited to the extent that the volatility is contained and mostly in the 3 to 5 year bucket.
So, Mrin, how are these schemes performed? Let's get to the brass tacks of it, because ultimately this is what an investor looks at. And also, if you're suggesting you're talking about a 3 to 5 year time frame, what are the kind of return expectations somebody should have when they are investing in a balanced advantage fund?
So when I looked at the rolling returns, when I look at 5-year and 7-year rolling returns, you're seeing returns anywhere between 10 and even some of them going to 15%, which could be a few outliers, because they might have had a higher exposure to equities at some point in time. But I would certainly say that that might be the past performance. Also, we should remember that we also had interest rates coming down. When you look at, for example, 5 or 7 years, right? So you had interest rates also falling as well. So I would actually, go with a 9 to 10% sort of a return expectation in the, with the balanced advantage fund category. And I think that's a reasonable expectation to have.
In the data that you've shared with me, in the rolling returns that you've shared, a couple of schemes stand out though, Mrin, and for absolutely phenomenal returns. HDFC Balanced Advantage, for example, 15.5% return over a 3-year period. You're talking about 15+% even on a 5-year and a 7-year period. And you also have Tata Balanced Advantage, which has a 14.5% over 3 years and more than 15% over 5-year and 7-year. What has worked for these?
So I think, in any fund, I think what typically works for them is the stocks or the sectors that they have possibly chosen that has basically given them this outperformance. I mean, specifically, I would not be able to comment on, HDFC or Tata, but I would think that it's the allocation to the stocks that they did where they had a good amount of outperformance to help them.
Varun, any insights here? Is it the equity portfolio that gives you that alpha? Obviously it is. And so therefore, can you have this kind of a divergence? And is it pretty much normal in a category like this?
So there's this very interesting study which was conducted, and obviously, I think BAPS as a category really comes into the limelight once markets deliver sort of negative returns or move sideways, right? In a bull market, no one really wants to talk about BAPS and multi-asset categories. So after September 2024 till about December, when markets corrected about 10%, BAPS as a category at a median level corrected only about 2.5, 3%. Right. So that is where also the outperformance, Alex, also comes into the picture, because a fund or a category which falls less vis-a-vis the benchmark needs to obviously recover that much less compared to the benchmark itself. So that is where also the outperformance also comes into the picture, because these funds, due to the inbuilt fixed income allocation, arbitrage allocation, they are able to protect the downside better. They are able to control the volatility significantly better, due to which once the markets recover, the recovery also tends to be faster. So obviously, if I look at a market which is moving sideways or in a bear market followed by a bull market, then over that 12-month, 15-month period, the outperformance over a pure equity index would be significantly higher. And that's what we have seen over the last 12 months as well, where Nifty has delivered close to about 2%, but the top performing balanced advantage funds have delivered in the high single digits, anywhere between 8 to 9%.
Yeah, it's not related, but it's something that will elucidate this point perfectly, Varun. And we've spoken about Parag Parikh FlexiCap Fund quite a bit. The reason why they continue to outperform, at least over the last 3 years, is they have had a sizable amount of cash, 20+% even as we speak right now. And so effectively that has allowed them to fall less than the benchmark and also peers. And so their down capture ratio, which effectively captures this, is only 20 in the time frame that I looked at. And the up capture ratio is, which is the movement vis-a-vis the benchmark, is at 80 for the time period that I looked at. So they've fallen much less than the benchmark, but they've also gained less than the benchmark. But all told, they've actually outperformed because they've fallen less than the benchmark. Okay, so we've kind of covered quite a bit of ground on this. And viewers, hopefully that helps you understand how to choose your balanced advantage fund. This consultation paper that came through on Friday that spoke about the potential or the proposal to allow a mutual fund house to launch a second scheme in a subcategory where the scheme assets under management are more than 50,000 crore rupees. And the possible reason for this is that if you had a strategy, for example, in a small cap fund where you wanted to be nimble, and of course small cap funds have a requirement to have at least 65% invested in small caps, you want to be nimble as a fund like that. So you want to give the opportunity to fund house to have a separate set or a fresh start where you can invest in more small caps. As the assets under management rise, you need to maintain liquidity as well, and so you need to keep money in large cap funds, and maybe that changes what you originally thought was the thesis. So of course the jury is out on this, Bryn and Varun. I just wanted your initial views on what could occur, because seemingly what they're saying is that if this is done by a fund house, they would have to stop fresh inflows apart from SIPs into the original fund and have a similar strategy, but they've not defined what that similar strategy will be in the second scheme that is launched with the same fund manager. The problems that I foresee is that you could have a gravitation away from the original fund where people redeem and move to the new fund. Why would they stay there? There could be problems with performance. Min, would you agree?
Yeah, so I actually have a couple of questions. And,
Yeah.
just looking from an investor's perspective, imagine you have two flexi cap funds, or if you have two large cap funds, where the investment objective is the same. Now, one of the points I did read somewhere, and correct me if I'm wrong, was that you are also allowed to have a different fund manager, right? So, I think just from an investor's perspective, this might turn out to be a little confusing, because you have two funds that are available, and you like people might just get confused between these schemes, and for whatever reason, what happens if the assets of fund one goes down, right? So I'm not sure about these aspects, how it will really play out. And there's always this propensity, right, as we see that investors want something new all the time, and they could even end up just redeeming, thinking that, okay, this fund has already touched 50,000 crores. Now it's not going to perform. So let's, move into a new fund, because there the fund manager also has better flexibility to deploy the funds, right? So I think, some of these, I have a couple of these questions, honestly, more than a comment on the
Yeah.
consultation paper. These are the questions that I have.
Yeah, absolutely. And it's fair to have questions at this point. Varun, at last count, at least my count, 1,791 schemes offered across various categories. And if you have additional schemes launched in these subcategories under the same threshold, if you had the paradox of choice before, you will have paralysis of choice now. Would you agree?
No, absolutely. I think there are already enough schemes and scheme categories and thematic and sectoral funds to cause immense amount of confusion at the investors level, and perhaps to some extent at the advisors in a distributor level as well. So I don't know how adding more to the same would help the audience in general. If anything, depending on how the strategy actually ends up being shaped, right? It just looks like there are a lot more questions than answers at this point in time with respect to how fund houses end up managing these strategies. But yes, we'll see. I think the devil lies in the detail, and we'll see what the regulator has to say more about it.
Thanks, Varun, so much for that, and Amrin as well. By the way, we had a conversation not too long back on Your Money Matters about how these very large schemes with very large assets under management, these old schemes, how they perform and how they have performed against their peers, and they've actually done pretty well if you think about it.